Hi, I'm Mike Capizzola from the Investing Channel, and welcome to IPGo, the show where we take a look at the IPO world, past, present, and future. Things have started to heat up again in the new issues markets, and the IPO calendar is filling up nicely with deals of all shapes and sizes. The number of new SPAC listings seems to have slowed, with only 3 new deals scheduled before the end of the month. That compares to the 433 SPAC listings completed so far in 2021 and the 248 deals seen in 2020. Among all SPAC listings, 452 vehicles are still looking for an acquisition, while another 400 have completed or are in the process of completing their deal. Special purpose acquisition companies get 24 months to find a deal target. If they fail to do so, they must wind themselves up and return their assets, principally cash held in escrow, back to their shareholders. And some 90 SPACs have been liquidated on that basis. With the SPAC craze on the back burner for now at least, we can look at some real businesses that are hoping to IPO in the near future, one of which is software as a service provider, Freshworks. The company provides its users with technology in areas such as customer experience, IT service management, CRM, and database solutions. That includes Salesforce and other marketing automation tools. The company has around 52,500 business users and generated revenues of $308 million from them over the last 12 months. However, that failed to translate through to the bottom line, and the company recorded a loss of $1.85 million in this period. The company, which is now based in San Mateo, California, and employs 4,400 staff around the world, was founded in Chennai, India back in 2010 and raised its first significant funding in 2011. It's now looking to sell 28.50 million shares in a range between $28 and $32 a pop to raise up to $855 million in fresh cash. That would give Freshworks a valuation of around $8.35 billion, which puts the company on a multiple of 27 times sales, a premium rating to the likes of Salesforce, Paycom, Intuit, and ServiceNow. The task of justifying that valuation will fall to joint managers for the deal: Morgan Stanley, JP Morgan, Bank of America, Jefferies, and Barclays. Freshworks is an interesting business, but the valuation looks rich from where we're standing. Another software business that may have a hard time justifying a premium rating at IPO is Toast, the Boston-based firm that provides restaurants with point-of-sale platforms. Toast's computerized and payment platforms are used by 48,000 eateries across the country, but of course, dining out was one of the biggest and most immediate casualties of the pandemic, and the industry has yet to recover fully, not helped by ongoing staff shortages and rising costs. Toast is looking to the future, however, and has designs on a valuation of as much as $15.70 billion. Revenues of $1.18 billion over the last 12 months may help to justify that figure. However, as with Freshworks, good turnover did not generate profits, and Toast's net income over the last 12 months was a negative $358.31 million. Toast will also look to IPO with a dual share listing structure, with A shares being offered to new investors, while B shares, which carry 10 times as many votes, will remain with the founders and their backers. Dual share structures can work, but for that to happen, IPO investors need to believe that the interest of those that control the company will be aligned with their own. Because if they aren't, then A shareholders can do little to change that down the road. Toast will try to sell 21.70 million shares in a range between $30 and $33 per A share in a deal coordinated by Goldman Sachs, Morgan Stanley, JP Morgan, KeyBank, William Blair, and Piper Sandler. The next generation of tech IPOs has been actively raising money from venture capital and private equity firms, according to research from S&P Market Intelligence. Fintech companies in the U.S. attracted $7.50 billion of new investment from venture capitalists in Q2 2021, and there were no less than 194 deals completed, which was a 70% increase over the same period during 2020. Firms operating in the payment space were the most active and saw the largest deals, including a $440 million funding round for Circle Investment Financial Incorporated, a business which builds payment infrastructure for enterprises involved in e-commerce. Overall, payment companies raised $2.40 billion in Q2 in 39 separate transactions, and though private markets and VC funding remains the go-to source of capital for most fintech startups, businesses in the space are feeling more confident about the possibility of an IPO, the S&P research found, which bodes well for the future. That's all we have time for today, but as usual, make sure you do your own due diligence before making any investment decisions.